Well, it's a form of financial derivative, and the term warrant is used quite widely for these types of securities that are rather like options. All warrants carry the right to trade in an underlying asset at a fixed price at a specified time or times in the future. There are two main types of warrants listed on the London Stock Exchange. The first type are issued by companies and investment trusts over their own shares. These are often called traditional warrants, and they behave in a very similar way to ordinary shares, with fluctuations in their prices determined by supply and demand. At the end of their lives, it's possible to convert the warrants into ordinary shares on payment of the exercise price. The second type of warrant is called a covered warrant, and these are quite different. These are synthetic securities issued by investment banks, giving rights over all kinds of assets, from market indices to major stocks through to currencies and commodities. You can buy covered warrants, for example, on the FTSE 100 index, on Vodafone, on the pound against the US dollar, or on the gold price. And in addition to call warrants, which allow you to benefit from rising asset prices, you can also buy put warrants, and these allow you to gain from falling asset prices. The prices of covered warrants are maintained by the issuing banks and are not generally influenced by supply and demand. It's a cash market as well, which means there's no physical exercise at the end of a covered warrant's life. Frequently now, when new traditional warrants are issued, they come in the form of subscription shares, which are really warrants by another name. They have exactly the same characteristics except for one tax benefit. Unlike warrants, subscription shares can, under certain conditions, be included in an ISA. Apart from that, they're exactly the same. The main advantage of warrants over ordinary shares is their lower price, and this means they offer something called gearing or leverage. Gearing means you can buy more exposure for your money, and leverage means that the price of warrants will generally move by much more in percentage terms than the underlying assets. This amplification of the returns does work in both directions, so both your potential profits and your potential losses can be much larger. Even in a poor year for equities, there have been some positive returns. Here's an example from the traditional warrants market. 3i Infrastructure shares have edged up over the last 12 months to 25th of November 2011 from 117.3 pence to 119.2 pence. That's a rise of 1.6%. Over the same period, the trust warrants have gone up from 15.5 pence to 18.25 pence, and that's a rise of 17.7%. These relative movements are clearly shown on this chart, with the share price in black and the warrant price in blue. The warrant price clearly displays much more movement in both directions. There's no hiding from the fact that gearing can exacerbate losses, and that it is possible to suffer a significant loss from just a small market movement. This is why warrants are usually considered as high risk, and why you're required to sign a warrants risk warning notice before you deal. The risk and reward payoff is not symmetrical though. Whilst there's no cap on the gains you can achieve from call warrants, you can never lose more than you invest. Unlike some other derivative instruments such as CFDs and spread betting, there are no margin calls, and you cannot face losses in excess of your initial stake. There's no prescribed holding period for warrants. It's really a matter of personal choice how long you hold them, and they can be bought and sold on the London Stock Exchange at any time during each trading day. Corporate warrants sometimes have maturity periods extending to a few years, whereas covered warrants typically have much shorter maturity terms, perhaps running for 6 to 18 months. Covered warrants can be very suitable for short-term trading, and this is how many investors use them, including in some cases for day trading. For both types of warrants, you can use your normal stockbroking account. There's no need to open any form of special separate account and incur extra paperwork. The dealing charges are exactly the same as they are for ordinary shares, except there's one small benefit, that there's no stamp duty payable on covered warrant trades. Again, this is a personal matter, but there's certainly no need to invest a large sum unless you want to. The minimum sum is really determined by the dealing costs, and I would say a few £100 is a decent sum with which to begin. Remember that the gearing can generate meaningful returns from a relatively small investment if you're successful. And of course, on the other hand, you do need to be comfortable with the risks. It's worth having a search around the internet for some other introductory guides. I think you'll find some very useful information on the websites of both of the major banks that issue covered warrants. Their web addresses will be coming up on the screen now. If you want to delve a little deeper, I have written a couple of books on warrants that you can find on the major bookseller websites, and I also publish a monthly advisory newsletter on warrants. Details are on our website at www.tipsheets.co.uk.